Okay, so maybe we could get started. All right. Good evening, and welcome to this, what is the last session of the day. So thank you very much for being here. Last sessions are not easy to kind of, manage because I'm sure since morning you all have been having a lot of information overload, but hope that your attendance here shows your commitment to the topic, and our panelists are going to provide you with some interesting insights, and that would generate some good discussion. So my name is Venkat Putti. I work at the World Bank. I'm the program manager for umbrella facility called Partnership for Market Implementation Facility. And the Compact with Africa is an initiative that is part of this umbrella. And Compact with Africa is actually a G20 initiative that was formally launched with when Germany was actually the chair of G20. And as the name suggests, it is actually a compact to promote climate action in Africa. And at the World Bank, as part of this facility, PMIF, we have been implementing this Compact with Africa Green Business Fund for the last 2 years. And the main objective of our initiative is to help create enhanced access to climate finance for the small and medium enterprises in Africa. And why are we doing this? Because, SMEs are really the lifeline of economies in Africa. There is an estimate that shows 85% of the African economy is run by small and medium enterprises. So it is our hope that if we really help the SMEs to green themselves, either to strengthen what they're doing currently or encouraging new entrepreneurship in this field, then that will be a major contribution to the overall decarbonization and adaptation agenda for Africa. So given that we are Compact with Africa, we are currently working in about 12 countries, which are members of the Compact with Africa. And the fund has 3 primary pillars. One is to help these countries in creating what we call the enabling environment and the right policies to promote green businesses in these countries. And the second one is to provide technical assistance to the key stakeholders, whether it is, of course, the SMEs themselves, but also the financial intermediaries and various other players, government officials, policymakers, etc., so that they can adopt right policies and programs. But perhaps the most important component of our program is really, helping enhance the climate finance through the use of innovative financial instruments. And that actually constitutes bulk of our program. And today's panel is actually going to focus on that, and especially on the guarantees that would help de-risk the investments for the SMEs. So we have a fantastic panel today to cover that. We are going to have Florence Budpa from I4C, who is going to speak remotely from Washington. And then we have Umberto Trivella, who is actually working with us on a study to do a market assessment in this region. And then we are also going to be joined by Kyle Durham and Eric Naivasha. At last but not the least, this session is going to be moderated by my colleague, Patrick Doyle from I4C. And Patrick is a senior investment officer with I4C Financial Institutions Group. And he has over 20 years of experience in clean energy and climate finance. with expertise encompassing solar, distributed generation, energy efficiency, and energy storage. And he has developed many financial initiatives with both growth and venture equity, guarantees, as well as other finance instruments. So I would now like to hand it over to him to run this session. Thank you very much.
Thanks, Venkata. Before I introduce Florence, I just want to give a quick overview of the session. I mean, the session is really detailed, and perhaps online it read as a very niche topic, but really this goes to the heart of what should multilaterals and governments be doing to leverage in private sector investment in climate finance. So it is really a high-level topic and a very important topic. We're going to try to talk specifically about guarantees and solar and SMEs, given the decades of experience in climate finance. But if you think back to the historical use of guarantees, there are lessons learned over 40, 50 years of governments implementing guarantees to try to get the private sector to invest. And it is a very complex tool. Lastly, we're going to focus on credit guarantees, so we're not talking about performance guarantees and energy efficiency and renewable energy on this panel. Our first presentation is from Florence Gupta, and she was just introduced with the IFC. I'll give a quick bio. She's dedicated the past 17 years to finding and supporting investment opportunities in emerging markets. She's currently the manager of new business for the Financial Institutions Group in the IFC, covering West and Central Africa, and oversees our investments in over 20 countries, including some of the most challenging and fragile markets. Florence, go ahead.
Thank you, Patrick. It's a pleasure to be with you all. I hope you can hear me well. Too bad I can't be in Bilbao. I hear you have good weather and lots of really good and interesting discussions. So as you mentioned, on our side, we have had now more than a decade of really pushing the limits when it comes to extending credit to SMEs through banks via this instrument, which is the risk-sharing facility. And I will go over some of that. So I hope that the presentation is being projected. I can't see it on the side, but I'm assuming you guys are following. And I know that I need to do this in about 10 minutes, so I will try and wrap up within the allotted time. Can you confirm the presentation's been shown? Oh, okay. All right. Okay. So anyway, as was mentioned, this is an instrument that we've been using for a few years. And really, the first slide was meant to show you how what the instrument is meant to do, kind of high level, and how it works. So if you're not seeing it on your screen, just picture a portfolio of SMEs. I mean, today we're going to be talking particularly about SMEs receiving climate funding in order to become, more climate friendly in their activities. So picture that loan portfolio and imagine that this bank wants to expand, and IFC or another DFI would come in and share the risk. The loan portfolio remains on the balance sheet, so there is nothing that kind of leaves the bank. The DFI, in our case IFC, shares into the credit risk of that portfolio. We agree ahead of time on eligibility criteria, but we leave the bank, the financial institutions, really to build that portfolio and report back to IFC. So this concept of delegation, okay, thank you, I see the slides now, is really important. And finally, in terms of the flows that happen between, IFC and the FI, of course, the FI, remunerates IFC for sharing the risk, and IFC pays a claim or the claims against the losses that they would face on their portfolio. So going into the next slide, this is really meant to show you over the past 15 years, really the spread, geographical spread of how we've been able to implement these risk-sharing facilities. Some of them, to be clear, with also a climate angle to them, but the majority have been general SMEs. So over $2 billion of volume for about 100 and more transactions. We do these transactions in the local currency portfolio of DFIs that we're working with, so there is no mismatch in currency for these transactions. As you can see in Africa, we've done these types of guarantees in over 22 countries, but we'll go over that in a bit more detail in a second. So the next slide, again, just expanding a little bit of what I said in my intro. When we do these risk-sharing facilities, we abbreviate them as RSF. Typically, the FI doesn't really have a funding needs. What it has is a willingness to expand, and we come in and provide that guarantee against the risk. So there is risk appetite that needs mitigation, and there is a willingness to grow a business line that has become really strategic. And so we need to make sure that these financial institutions has the adequate underwriting standard to do it. But obviously what's in it for them is that they can grow market share, they can grow faster than they would otherwise without a guarantee. They can create new products that are adapted to the kinds of SMEs that they're seeking to target. And we can provide advisory services to strengthen utilization. We can share best practices from other markets. As you have seen, we work across several markets. And of course, we can, some of these advisory services are kind of embedded in our regular offering, but we can go even further down and provide value-added advisory services to help them reach their end borrowers. We have found that without, by the way, these advisory services, it doesn't really work. Just go back a little bit because I just wanted to finish on that slide that in terms of I4C, what's in it for us is obviously that these borrowers would be too small for us to reach directly as an institute, as a large institution. So going through the FI is a benefit for us. We're going into harder to reach markets and we're pushing the limit every day. And you'll see that in the next slide to seek, demonstration effects in the market that we're working with. And typically, we use this as an entry product. And then subsequently, we either do sequel RSFs or perhaps provide longer term funding or whatever it is that the FI might need. So in the next slide, I wanted to show you, the various risk sharing facilities that we have proposed. But obviously, I know that today we're all thinking about how to take this particular initiative into the climate world. So one, very key product and critical that we have launched now 3 years ago, I would say 4 years ago, is the Small Loan Guarantee Program, which targets, as you can see here, micro, small, and medium enterprises, including very small enterprises, women, SMEs. And, this has been supported by what we call internally at I4C blended finance, which is critical for, allowing I4C and the institution to grow by taking some risk at the onset. And, this it's a 400 million program that has now approved 18 projects with about 206 million equivalent volume, and we still have 15 active projects under this one. We're enlarging the scope of SLGP from 35 to 58 countries, and that's the second facility you see on this table. Same target market, additional first loss from European Commission, like I said, to target more countries. To just give you an example in terms of facilities that have a bit of a different flavor, medical equipment, meaning healthcare, is an area where we've sought to grow, a 100 million facility that was launched 3 years ago. And creative industries is another area where we've sought to grow. So again, maybe next step would be to create, a similar RSF program for climate. Next, please. Again, just really, as I mentioned, in Africa in particular, over the last 15 years, IFC has supported over 55 of these RSFs in over 22 countries. The range of transactions varies, but as you can see, we've done transactions as small as 2 million, as high as 12 million. But what I really wanted to show here is that as we're learning how this product needs to be used, we are seeing a lot more utilization of the facilities we put in place. So the first graph to the left shows you that, as you can see, the large bar to the right, a large number, the majority of our transactions are 80%, utilized and more, and the vast majority between 40 and 100%. This graph to the right shows you the number of SME facilities that are reached, and 16 of our RSFs have already reached more than 200 SME facilities each. Next, please. So in terms of particular zooming in the small loan guarantee program, which is, like I said, kind of our key program, I've given some details about why it was created. Really, what you need to, keep in mind is that the program is now more efficient because it provides standardized pricing and simplified terms. So it really helps us streamline. It's quite focused even in terms of portfolio supervision because we have an internal team that kind of gathers all the information and keeps it very efficient both internally and for the donors. We've adjusted the program so that when utilization might be low on certain places, we might be able to reallocate on others. So there's quite a bit of efficiency that has been learned so that the product has reached the kind of scale and the kind of success that I had seen in the previous slides. Next, please. Again, we've seen this one a little bit before. Maybe one thing I could say, in addition to what I said earlier, is the multiplication effect, right? So once we provide IFC exposure, obviously the bank can use these facilities multiple times over the, what we call the portfolio growth period. And so what we have found is, almost 3 times our maximum IFC exposure has generated in terms of portfolio of loans, right? So 166 have generated about $413 million in SME loans. So it's a really powerful instrument that we have, that we have put in place. I will stop here, and in case there are questions, I remain available. Thank you.
Thank you, Florence. Next, we'll hear from Umberto about an ongoing study of the appropriate design of guarantees for small-scale solar projects in Africa. A little bit of background. Umberto is a financial inclusion and project management specialist with over 15 years experience in MSME financing, value chain finance, digital finance, and energy finance in over 20 countries. He's at CIDR Pamiga.
Good. Thanks, Patrick. So yes, I'm going to present some of the findings of a market study that CIDR Pamiga has been contracted by the World Bank to conduct. It's a study on scaling up of off-grid solar in 6 West African countries, which are Benin, Burkina Faso, Cote d'Ivoire, Ghana, Togo, and Senegal. The main objective of the study was to understand the technical and financial needs of key stakeholders in the sector, starting with solar companies, solar SMEs on one side, and financial institutions on the other. And secondly, to scope the potential for a risk-sharing facility for local financial institutions to increase financing to solar SMEs. So we've interviewed a total of 147 stakeholders in the 6 countries, of which 44 financial institutions, 43 solar companies, 36 institutional players comprising ministries, electrification agencies, donors, NGOs, and 18 managers of financial instruments. So when we speak of managers of financial instruments, this could be guarantee facilities or guarantee funds. It could be development banks and funds and development finance institutions, DFIs. So what are some of our key findings? To start with, we found that overall, the experience of interviewed financial institutions in financing solar companies and solar projects is limited. Banks have mainly issued some cash advances or factoring instruments or project financing to companies that have secured contracts, so basically secured or guaranteed markets, if you will. MFIs, so microfinance institutions, on the other hand, have mainly provided end-user finance, so have funded clients to purchase solar equipment. There are a number of investment funds which are providing debt and equity financing, but mainly in hard currency. And last, there's a few leasing companies that have leased solar equipment to farmer organizations. But as I said, overall, the experience is limited and the portfolio is small. What are the challenges? There's multiple challenges. There's challenges at the level of solar companies, which are similar to challenges of other SMEs. You know, weak business and financial management skills, lack of collateral. There's challenges at the level of financial institutions because their knowledge of the solar sector is low. Their existing product offer is inadequate. The loans are also very costly, ranging easily from 12% to 18% per annum, much higher even in Ghana. There's constraints at the level of solar equipment. There's still a proliferation of low-quality products. The equipment remains expensive, so it's not affordable for the kind of target low-income clients that often are targeted by such products. And there's constraints at the policy and regulatory level with, an environment which remains, insufficiently conducive. So fiscal incentives remain limited, the procedures are cumbersome, etc. In terms of current access to risk-sharing facilities, we have found that most banks have access to risk-sharing facilities. It's normally from regional or international providers, mainly for SMEs, SME loans. These have a range of conditions. It's portfolio or individual guarantees, largely pari passu, meaning with a risk coverage rate ranging from 50 to 75%, commissions ranging from 1.5 to 2.5% of the guaranteed portfolio. MFIs, on the other hand, have access to guarantees normally from government or project-related facilities with concessional terms, if you will, meaning that commissions there can be no commission at all, or commissions ranging from 0. to 0.75, 0.5 to 0.75, again with a variety of conditions. And overall, the interest of interviewed financial institutions in a dedicated guarantee instrument for solar financing to finance the solar sector or solar SMEs in particular is high. They claim this would enable them to reduce collateral requirements and possibly also interest rates to such kind of SMEs. Just a quick look at some of the existing risk-sharing facilities. One of them is the African Guarantee Fund. It is a subsidiary of the Kenyan-based AGF. It covers 15 ECOWAS countries in Mauritania. It offers individual and portfolio guarantees to partner financial institutions which provide loans to SMEs. Conditions are pari passu, unfunded guarantees with coverage rate ranging from 50 to 75%. And they do have some experience in the solar sector by providing a guarantee to UTB Bank in Togo for a $3.3 million loan to B-Box. This is back in 2017. Another example is the risk-sharing facilities from Proparco, which is the private sector arm of the French Development Agency. They have a short-term guarantee, and then they have other two instruments called ARITS and URITS. They're basically individual and portfolio guarantees to financial institutions for both short-term loans, so less than 12 months, and medium and long-term loans from 1 to 12 years. Again, it's unfunded guarantees, silent, they call them final loss, meaning that the guarantee is paid after all other recovery efforts have been taken. The coverage rate is from 50 to 70%, and the commissions are variable, but from 1 to 2.5% normally of the guaranteed portfolio. So to conclude, we believe there's an opportunity for a dedicated risk-sharing facility, potentially with alternative terms or different terms from what we found. And some of the things we could think about is, for example, to include some first loss coverage as opposed to pari passu, which is what most of the guarantees we found are offering. What is the advantage of first loss? Obviously, to encourage FIs to create new portfolios in sectors that they perceive as risky and where they would not venture otherwise. The minus of first loss is that there's a moral hazard, of course, stemming from 100% coverage of risks, because obviously in that case the financial institution does not bear any risk. There's also a question about funded versus unfunded guarantees. Funded guarantees means that the plus is that the cash is deposited at the FI, at the financial institution, bringing, of course, boosting confidence in the facility, potentially making the guarantee calls much quicker. The minus is obviously that the guarantee needs to tie up its assets at the FI. So to wrap up, I think I can probably ask this question to the panel, whether they believe there's an opportunity for a blended guarantee facility which would combine both some first loss coverage and pari passu cover. But perhaps we can discuss this during the session. Thank you.
Thanks, Umberto. Let me introduce our other two panelists now and give them a chance to speak. Eric Naivasha is the Associate Director for Energy, Environment, and Climate Change at the Equity Bank, based in Nairobi. He has over 22 years' experience in finance and business, and has designed and implemented projects in renewable energy, energy efficiency, climate-smart agriculture, as well as water and the circular economy. And then to my left is Kyle Durham, a qualified chartered accountant and the head of sustainability for the commercial bank at First National Bank, which is part of First Rand in South Africa. He has been responsible for the strategy and development of this commercial and industrial scale renewable energy products at First National Bank over the last 5 years. And over the last 2 years, he's been responsible for developing and implementing a strategic response to climate change for the bank. Eric, would you like to start by talking a little bit about your experience with guarantees with Equity Bank?
Thank you very much, and nice to be here on this panel. Before I respond to that, I would like to react a little bit to what the two presenters have presented, especially from what Bart has presented from West Africa. Because what he has showed us is banks do not understand the sector. This is very true. You know, if you look at the West Africa experience, it's end-user finance by microfinance institutions, advances here and there. But what he's telling us is that banks have not really understood the business models of solar paygo companies, for example. And that is true to some extent, because it's just in the last couple of years that we've started even integrating our systems with paygo companies and financing receivables from paygo companies. Now that we're beginning to understand a little bit about the sector. So I think the findings are really spot on. And also the comment on the first loss, pari passu guarantee. I think what we have consumed in equity is really pari passu guarantees. We are on URIs, we are on ARIs, we have Africa Guarantee Fund that we are consuming. But there is a very compelling reason why we should also consider first loss. especially for very riskier markets. Coming back to your question on our experience with guarantees in Equity Bank, I would start by saying that Equity is a retail bank. 65% of our portfolio is in SME. And for a bank that has over 18 million clients, then you can imagine it's quite a big chunk that we are holding there in the SME side. And that presents an excellent greening opportunity for SMEs. The question is, we are already struggling to lend to SMEs because of the reasons that we've been told of, collateral requirements, they don't have business plans, we can't see their cash flows. Then when you add climate finance to that equation, I think the problem becomes a little bit more in terms of what kind of de-risking instrument then do you need to put together to be able to expand your participation in SME. So what we have done is we've categorized our clients, our SMEs, from number 1 to number 8. That's how our clients are categorized. From number 1 to 4, those are less riskier category of clients. We can lend to them without guarantee because we understand them, they have a good business plan, we can see their cash flows and all that. From number 5 to 8, on what we call the strength of relationship with the customer, is where we have a problem. And the issue is those SMEs that fall between number 5 and 8, which are more riskier, that's where the bulk of our clients are. So if we don't service that market, then we are not addressing the real issues. We are not growing the SMEs. So we've come up with a plan of financing 5 million SMEs in the next 3 years across the 7 countries that we operate. And that program has started, and we're working with a number of partners there. And what we have done is to combine guarantees. So we are consuming guarantees, whether it's from Africa Guarantee Fund, URES, ARIS, and others. And they are not all unfunded. They are all unfunded guarantees. Is to combine that with capacity building. Because an SME for us that falls between number 5 and 8 is very risky. Guarantee alone will not help. So what we have done is to combine capacity building of SMEs, guarantees, and what we call ecosystem approach to banking. Those 3 things are the ones that are preparing us to lend to more SMEs. Now we've lent to about 515,000 SMEs under that particular program. Over $2 billion invested in those SMEs, leveraging on those 3 things: ecosystem, guarantees, and capacity building. For us, our first line of defense is capacity building. We've demonstrated over the years an SME that goes through our training program and comes for a loan to solarize their business, their repayment is 700 basis points better than SME that has not gone through that particular training. So when you add the guarantee there, and our SMEs populate the value chains of corporates. So when we are working also with the corporates, you're able to see the cash flows of the SMEs. So we combine the ecosystem because an SME is supporting, is populating a value chain of a corporate. And if I've onboarded the corporate as an anchor in my system, then I'm able to see the cash flows of all the SMEs that are populating that value chain. So those are how we have utilized guarantees. And what then we have done is to ensure as we lend to them, we are learning. We are creating lessons, we are creating new products, so that 5, 6, 7 years, we don't need guarantees to lend to that segment of the market. Essentially, you are removing them from number 6 in our ranking to number 3 to number 2. because now we are understanding their business model. So it's just seeding. For our last guarantees is to seed us to understand that segment of the market that we would not have otherwise lent to. I think I'll stop there.
Okay, thanks. We'll have a little more time for questions, but Kyle, I mean, given the energy crisis in South Africa, which is a huge threat to the economy, but at the same time a boom for distributed solar and storage potentially, maybe you can talk particularly about First Rand's investments and the barriers to climate versus just SME lending.
Yeah, so Patrick, I think it's probably the perfect storm, if we could kind of call it that, in that, kind of SME lending, to kind of Umberto's point and Eric's point, is a really kind of a tricky environment, for all the kind of points mentioned. You've got kind of weak balance sheet. In the emerging market, we've got a situation that, the net asset value of the shareholders, is not, kind of comparable to developed kind of markets. So your net asset value and the equity requirements for lending is just simply kind of not there. And then you kind of bring kind of climate finance aspects. So even in the case of something like distributed generation, you've actually got the situation that, kind of solar equipment is traditionally kind of poor collateral. So you've got to start thinking of kind of alternative, of kind of real alternatives of lending. So, in our case, I mean, your guarantees hasn't been something that we've needed to rely on just kind of yet. We've got some kind of schemes that we can chat about that our kind of government is bringing to the party to kind of provide some additional capacity. But strategically, I mean, we are really supporting our SMEs, through this energy crisis and assisting them, with their transition to solar PV and distributed generation in particular. And for us, I think it's a good marker and a model for future climate finance, in the sense that, you actually cannot separate, in our view, kind of climate finance and almost an advisory element to your customers, in the sense that in an SME's world, and actually for many businesses, even larger businesses, energy and climate and actually sustainability as a whole is actually not core to their business. It's soon kind of becoming core, but if you're not playing a role as a financial institution and the bank, you're finding a situation that it's a difficult investment decision to make. So our first kind of port of call is actually an advisory role to our customers. So and it's actually quite informal. It's education. It's potentially sitting and kind of unpacking a bit of a tender process, making our customers feel more comfortable with that kind of distributed generation investment that they need to make. And then it's applying an appropriate finance model for that customer. So there, we're looking at potentially the right tenure is one element. Kind of how much equity is required. We try to remove kind of those barriers as much as possible. And then finally, really bringing the kind of project fundamentals. So not necessarily kind of applying a project finance or an infrastructure finance kind of approach to this type of lending, but actually saying, what are some of the project fundamentals that we can actually rely on? What are the cash flow benefits? What are the property kind of valuation benefits? And actually providing those to the customer. So that really gives us kind of some significant foundation to build off of. And then when you start applying some additional capacity from a guarantee, such as the South African bounce back loan scheme, which has been provided by National Treasury, you then are able to do that much more. And provide that much more scale, and we're starting to see the fruits of that kind of coming to the fore now, with the bounce back loan scheme being kind of implemented, through the last couple of years, not necessarily just for kind of energy funding, but for SME lending, and now being applied to kind of energy funding going forward.
Could you quickly just describe in brief terms the bounce back loan scheme so everyone understands the terms that the government provided?
Perfect. So bounce back is really a COVID relief scheme that was implemented to SMEs in South Africa. It's really got the kind of name is kind of says it all. It allows SMEs to bounce back kind of post COVID. And we deployed about $50 million in kind of lending on the back of the scheme. It's effectively a portfolio guarantee scheme with first loss, a 20% first loss, that allows that we actually utilize to reduce the pricing. So it was an unsecured lending into SMEs that we then reduced pricing, the cost of borrowing for the SME. We've now utilized it as that same scheme, and then the new scheme that's specifically for energy to really talk to providing energy finance, and there we've actually removed all the equity, kind of the deposit requirements or equity requirements, and also provided some kind of cost of funding benefit to the customer. So it's being applied in a kind of a wider scheme at the moment.
Okay, Florence, if we can ask you to come in again, could you talk a little bit about some of the barriers historically with multilateral guarantees and perhaps tools that we've used to overcome them? Umberto mentioned blended finance, and that was in your presentation as well. Is that an essential piece of most of these programs?
Yes, no, absolutely. So I think, number of panelists have mentioned, areas around the risk, right? And for financial institutions, of course, risk is paramount. And what happens is, blended finance allows us to obviously onboard the risk, but also, as was mentioned, to allow the pricing to not be so prohibitive that the end beneficiary, so to speak, the SME in this case, would still receive the financing at affordable rates. So there is a pricing element that was mentioned, which is critical, because obviously if you're pricing just according to risk, and you're entering an area which is fairly new, where there's a lot of factors that come in and add to the uncertainty of the cash flows, then you really need to address it. So blended finance is critical. One thing perhaps was mentioned, but I would, without being too technical, I would mention about the novelty of the approaches that we've had in the past 15 years, in the past, I would say more 5 years, has been pooling the first loss across several facilities in several markets. And I think I alluded to this, again, without being too technical. What that does is it allows you to do facilities sometimes that are small to encourage the institution to grow, to obviously go into the more difficult markets, but also, and so these facilities would tend to be quite risky, but you can also onboard perhaps facilities with less, larger facilities with more established financial institutions, all in that same pool. So pooling the first loss has been a really, really important aspect of our work in fragile markets where, obviously the impact of climate is profound. I think one key point has been advisory, and again, it has been really, really emphasized, I think, by both, by all the panelists. You have to have it at the level of the financial intermediary. They need support. It's especially the ones that tend to do more corporate funding. SME funding is a totally different ballgame. But it also is quite useful at the level of the end beneficiary. And I think that's what was mentioned by the gentleman from both equity and I believe First Rand, because the end beneficiary also needs to be onboarded in terms of their business activity, so that, of course, your risk ultimately gets gets lower. So I hope I've addressed your question.
Yes, that's great. I think we don't have time to get into all of the barriers and lessons learned on guarantee programs, but it's both the financial barriers and getting the risk right, ensuring that you're taking enough risk off of the private sector, but then there's the administrative issues often with guarantee programs too, and their complexity and the reporting, and you're talking about leveraging small loans. So there's been plenty of programs over the decades that have never dispersed for other reasons other than not taking enough risk off the private sector. I want to reward you all for staying, and I couldn't bring beers, unfortunately, but we only have 5 or 6 minutes left before happy hour. Can I ask for any questions from the audience? Yes, please. Why don't you speak and I'll repeat just to start.
I'm really interested in the South African lending program done on energy. First question is, now South Africa uses a lot of coal. So any level of lending that you would have done to the SMEs would have resulted in some level of carbon accruing, right? Did you take anything from all those lenders? Did you get them to transfer carbon to you, or the carbon rights, or renewable energy credits, or anything at all?
No, so it's a great question, and it's something that I mean is actually an enhancement to actually, you know, the let's call it the SMEs, call it the asset that they own, is that this lending is done purely against the renewable energy infrastructure, so the solar PV or biomass. It doesn't actually include any environmental attributes that's been considered in the call it funding model. So they are free to utilize their kind of solar equipment to accrue, you know, kind of carbon credits and monetize carbon credits for their benefit. So there's an additional kind of value add there that we are kind of be working on kind of monetizing for our customers as well.
So just to come back on that, most small businesses do not have the manpower, infrastructure, and capacity to go through this carbon registration program. So, you know, because I have actually been looking at this for Sri Lanka. As you know, Sri Lanka also had similar problems last year as a result of the economic crisis. But the reality is that you're never going to get an SME going to go through the process themselves. They don't have the resources, they don't have the time, and they don't have the bandwidth when you're crisis, you know, trying to fight a crisis. So what would be very, very useful if you're lending money to a bank is to say, okay, so the bank can basically turn around to the company and say, whatever carbon that can be accounted for from the rooftop solar you're putting on, you can have a look at that from satellite. You can actually compute it. If you aggregate all that up, you then have a secondary revenue stream, which can then surely be used in some kind of first loss provision or some kind of mitigation activity. I'd really like to talk to you straight after this and see if there is a way we can learn what you've done and look at how we can improve it, and then maybe go to the IFC. And just final question, what's the interest rate you charged for your lending?
So the interest rate is actually you know, kind of, I would call it exceptionally competitive considering kind of the risk profile. It's it's below the unsecured kind of average lending rate and risk. It is obviously risk dependent of the SME, but in most cases it matches the kind of working capital or the cost of kind of property finance, which is quite heavily collateralized. So we've done a lot of work to make sure that we're incentivizing our customers for this kind of lending purpose, because there's a direct sustainability benefit.
Thank you. Thank you.
Yeah, I think you had a great question. I don't want to tip off Umberto, but we have a procurement we're going to undergo to try to figure out how to do that for distributed generation in South Africa. And it has been a challenge. I mean, in the old days, you had programmatic CDM that tried to address that, of aggregating the credits and then allowing someone to claim them. But I haven't seen it even in Mexico and Brazil with massive DG platforms that anyone is actually aggregating the cells or the carbon credits. So it's a topic, maybe it's being discussed at this conference, but it's definitely still a challenge even in the more developed markets. Is there another question? Nobody else for the... Well, can I ask you all to give any final... Florence, do you have any final comments? And we'll do a wrap-up.
No, I think this was a really interesting session. As you mentioned, I think the next step for us, because as you know, IFC has the ambition to do 40% plus of its financing in climate related work. So we do have the ambition to, take out the next step in terms of a platform. With the support of your group and others, I hope we can find solutions to, to implement those and to scale very quickly. So no, thank you for the opportunity, and sorry I couldn't be there in person.
Thank you. Would you guys each like to take turns with some final comments?
Yeah, I think, Patrick, one of the kind of elements as we've been kind of debating, kind of guarantees, both internally and actually kind of, at the conference is actually this point that sticks for me is that I think for climate finance and sustainable finance in general, I think as financial institutions, we've got to get quite comfortable with, if we're wanting to do a lot more as a commercial bank, we need to get quite comfortable in utilizing guarantees and having them structured to meet the requirements. So it's really about kind of taking hands and actually having kind of a proper bespoke conversation around what our requirements are and how strategically we see them being utilized. So I think there's a lot of work ahead for us.
Yeah, two things. I think we need to explore guarantee conversation in the context of carbon financing because as banks, we've not been very comfortable in financing carbon projects, which are predicated on future cash flows. And we are trying to see whether guarantees can play a role for us to unlock financing for carbon projects. So that's the first, I think, challenge that as bankers that we need to take. And I fully agree with Kyle here in terms of utilization. I think we found that when we consume these guarantees, then we are still shy to lend. The level of utilization is not as high as the numbers I saw Florence flashing on some of the slides. That I think we really need to get out of that comfort zone and start utilizing these guarantees. And for us, we are actually thinking of introducing KPIs on utilization so that we are not just consuming the guarantee. You actually are just not on structuring the guarantee, but how are you utilizing it? Because it's through utilization of the guarantee then you learn that new asset class, that new market that you would not have lent to without the guarantee.
Yeah, I would, in Italian I would say that Eric has stolen the words from my mouth, because this is exactly the point I wanted to make. I think that there's an opportunity for a dedicated risk-sharing facility, dedicated to really, solar or renewable energy financing, because the existing, although there are a number of existing schemes already out there, financial institutions are not really using them for the riskier targets. So they would rather use them if there's a guarantee for SMEs. They're not going to want to venture into lending to a solar SME. They'll rather use it for their standard SMEs that they're more comfortable with. So having a dedicated instrument with KPIs as well, because obviously, having the instrument there goes with, using it, so proving that you can use it and having performance targets related to it. And of course, capacity building, obviously, because capacity building for all the players, for the DFIs to get to know the solar sector, get to know solar SMEs, and for SMEs, solar SMEs themselves to present, an adequate business plan, cash flow balance, financial statements, etc. So I think all of these combined could make an ideal structure for a risk-sharing facility for the solar sector or for the renewable energy sector.
Well, thank you all. We're definitely open to more inputs on this topic, and I think it's an evolving field that hopefully will, in the next decade, will solve, but will definitely come up with structures that are actually being fully utilized and really helping the local banks go beyond the business as usual. So appreciate all of your time.